In my research, I focus on household spending because I believe in the recent recession, this is one of the most important component of GDP. Overall, consumption is always the biggest component of GDP, is around 70% of GDP in the recent years after the war, basically. So looking at consumption, why consumption drops, is always an important driving force for the business cycle, both recessions and booms. In particular, in these years, consumption spending has been interesting because of the behavior of the housing market. So one other important feature of the recent economic outlook has been the big boom and bust in the housing prices, and of course this is something that hits households particularly heavily. And so this is why looking at why households had to cut their spending is one of the main important feature to understand what happened, why there was no demand and why there was less job creation, and why the economy has been behaving in a dramatic way. Savings for households is one of the most useful tools to smooth consumption over their lifetime. So households, we like to consume having a relatively smooth path of consumption over our lifetime. We don't like to consume a lot when we have a good increase in salary for a year and then consume very little if we lose our job for a year. What we like is instead to construct some buffer, so accumulate wealth, so that in case of a reduction in our wage or a job loss, we can reduce this buffer of saving and use it to consume. In general, if financial markets were perfect, that could be less problematic, because households could go to the banks, borrow money in case of losing their jobs or in case of a big reduction in their wage, and then repay when their income is catching up. Unfortunately, financial markets are not perfect, and in particular, households that are poorer tend to have less access to credit. This implies that when lots of households in the US are financially constrained and they need to build up saving buffers by themselves. This is actually precautionary savings. It's the savings that households want to build to make sure that they can face a loss in income without having to cut in consumption spending. So we have a picture of the US of the recent recession where we have big increase in saving, but not saving in durable goods, rather saving in liquid assets, a big drop in consumption. If we look inside consumption, we have two main components, durable goods and non-durable goods. The biggest drop in consumption has been in durable goods. This is also due to the fact that to borrow to buy durable goods, households need collateral, and the value of this collateral dropped dramatically during the recent events because of the drop in housing prices. When many households in the economy start increasing their desire of buffer in safe assets and liquid assets, these tend to decrease the interest rate of these assets, because the price of these assets increase, everybody wants to hold them, and then people are more willing to accept lower return to hold this type of assets. This tend to push interest rate down, and at some point households are willing to accept even a zero nominal interest rate to hold assets, to hold liquid assets. This can mean also real interest rates that are negative, because we know that typical inflation is positive, so nominal interest rates are not a real interest rate in terms of purchasing powers that people get as a return on their assets. The people are going to be willing to accept a real negative interest rate even. Of course, this is a problem. This is called liquidity trap. A liquidity trap is a situation in which the households are so desperate to hold liquid and safe assets that they are willing to accept a zero nominal interest rate. A liquidity trap is particularly problematic for a central bank because the conventional tool of monetary policy for a central bank is the short-term nominal interest rate. If this nominal interest rate is at zero, the central bank cannot reduce the nominal interest rate further. And during a recession, what typically the central bank can do to help mitigate the economic downturn is to cut nominal interest rate to stimulate spending. This tool is not available at the moment, as has not been available for a couple of years, since 2008, when the US economy went into a liquidity trap. And so central bankers had to go and try to find non-conventional monetary policy to stimulate spending back up. The question is how households deleverage. So one thing I mentioned so far is household can deleverage by cutting in spending. And this is one natural way of doing it. If you want to increase your saving, you can just spend less and put your income on a checking account. Another way of deleveraging that households have access to is to work more. If they work more, they may have more income and they can use it to save more and increase their precautionary savings. However, a problem in the recent recession is that really when people wanted to work more, there were less jobs because the demand was lower because of the same reason, because people didn't want to spend. And so this made the recession even harsher by increasing unemployment level and by making labor markets much more tight than usual. Thinking about government policy and monetary policy to face the recession, to help stimulate spending, is clearly one of the important terms of debate, economic debate these days. Our research showed that there is one natural way to help the economy in a situation of financial crisis where households want to increase their precautionary savings, that is, inject liquidity into the economy. So one policy recommendation that comes straight from our model is that injecting liquidity in the system can help mitigating the recession by helping stimulate demand. However, one more subtle issue that we can understand thanks to our research is that how this liquidity is injected is very important. Our research showed that injecting liquidity in a lump sum fashion, so in a homogeneous way to households, may be much less effective than targeting people that are particularly prone to being liquidity constrained. Central bankers typically use nowadays, and have been using for a while, macroeconomic models that have a representative agent. And this is the typical macroeconomic model that has been the workhorse macroeconomic model in the last decades, as typically features a representative agent that behave as all the agents in the economy. However, this recent crisis and the role of precautionary savings and financial access to credit, make relevant to think about the fact that in the same economy there is heterogeneity. So some households may desire to borrow at the same time when other households decide to lend. So rich households or households with a lot of wealth may decide to save, and so to put their income into savings and lend to other households, in a sense, through the intermediation sector. At the same time, there are people in the economy that are hit by bad shock, that have a loss of job or a reduction in their wage, that prefer to borrow, sorry. And this is a key feature of our model that I think is important, that is considered in the models that central bankers use to think about monetary policy these days, to face the complexity of the access to financial markets and the complexity of the reaction of the economy to a tightening of credit availability.